This video is an explanation of the reading comp passage about savings and loans banks. This could be watched in conjunction with any question about the passage. The question itself, of course, is explained in its own video explanation. And I will say, if you're answering several questions about this passage, I would urge you to do all the questions before you watch this video. That way you'll be answering the questions with your own understanding of the passage. For much of the 20th century, savings and loans, or S&L banks, made mortgage loans to individual middle-class families, allowing many to buy houses. In the 1970s, the combination of inflation and falling oil prices created economic conditions to place S&L banks at risk. In the early 1980s, Congress deregulated the S&L banks, allowing them to expand the kinds of investments from which they drew profits. So very interesting. These banks had existed for a while. Things were happening in the 70s which put them at risk. And so in the early 80s, Congress was trying to help these banks by deregulating them. The second paragraph tells us the deregulation was designed to open beneficial options which would allow the flagging S&L banks to save themselves. Instead, many S&L banks pursued investments in sectors they did not understand well, such as commercial real estate. They entered these sectors with large amounts of cash, although they were not fully apprised of the risks. The collapse of the housing market in the mid-1980s, following an unprecedented building boom over the previous 10 years, led to the failure of numerous S&L banks. As these banks were protected by federal insurance, this collapse cost the American taxpayer over $100 billion. Some of the S&L banks that failed, the bank leaders were found guilty of embezzlement or other kinds of fraud. In some cases, the burden of fraud caused otherwise viable banks to fail, and in other cases, a bank that was going to fail anyway had its life prolonged by fraud, creating additional expenses for the federal bank bailout. So we have a compound problem here. So deregulating these banks, first of all, opened them up to all kinds of risk, and a bunch of them failed purely as a result of the deregulation. But then it was compounded by the fact that there was fraud, and in fact, widespread fraud. And this all increased the cost to the taxpayer. Former bank regulator William Black has argued that the U.S. government has not adequately learned important lessons from the S&L crisis. So here we're getting an argument. Everything before this was mostly factual, and here we're getting a particular interpretation of this past event. While stronger regulations for all banks are in place, little has been done to strengthen the fraud process. So just the process of deregulation, regulated or unregulated, sounds like the government is doing the right thing there with the stronger regulations of the banks. But on the side of fraud, it sounds like Black is saying we're not doing enough. Black has pointed out that bank fraud has the opportunity to thrive whenever regulation or oversight is loosened, and systematic occurrences of bank fraud pose a major risk to the well-being of the economy. While individuals may resist fraud because of their own ethics, this is not sufficient to protect the economy as a whole. The paragraph continues. Congressmen, responding to Black's charges, argue that the SEC has in place strict guidelines for what constitutes bank fraud, and that both SEC investigators and congressmen themselves are well poised to detect even individual instances of fraud, to say nothing of widespread fraud. Black points out that SEC investigators do not have a criminologist training. While they understand the rules well, they are not familiar with all the methods used to subvert or violate them. All right, so that's an interesting point. This implies that a criminologist, someone presumably who studies crime, not only knows the laws, but they know how a criminal operates. They know all the ways that a criminal will use to try and get around the law or break the law. And the SCE investigators don't have that kind of experience. They know what the rules are, but they don't necessarily know how people will tend to break the rules or how they're going to try and be sneaky and get around the rules. Furthermore, congressmen, under certain conditions, can turn a blind eye to bank fraud. For example, in the 1980s, the so-called Keating 5 senators accepted cash contributions from Charles Keating, the head of an S&L bank, and in return gave Mr. Keating undue protection, which allowed him to continue his fraud. And so this is further evidence. So Black, responding to what the congressmen point out, First of all, the SEC investigators don't have the criminologist training, and also the congressmen themselves can be bribed. It's happened before, presumably it can happen again.